away the Eurozone tail risk, you take away this fiscal cliff risk, and you throw in QE for good measure, it's all looking pretty good for equities, but is it too good to be true?
Well, I think that's a fair summary of where we're at. It seems to me as if European equities is a very good place to be next year. I think we're starting from a pretty compelling space in terms of valuations. Quantitative easing is providing plenty of supply. So yeah, I think Europe is a very attractive place to be relative to history and relative to other equity markets around the world.
But there must be some risks somewhere.
Well, there are risks, and I think that clearly, you know, we saw the other day with the resignation of Monti from the Italian technocrat government perspective, that will create elements of uncertainty. But there is the longer term perspective, i.e. Eurozone resolution, is very much out there, and policies will be adjusted as we go through that muddle through process.
So where are you looking specifically in Europe in terms of both sectors and nationalities?
Well, we've got quite a constructive view, as I say, on the overall market, and that leads us into some of the more cyclical areas of the market: industrials, consumer discretionary. We like luxury goods, we like the leisure sector, the media sector, and on the industrial side, capital goods and commercial services. I think we're finding more and more opportunities within the peripheral of Europe, actually, as those economies are going through their austerity. Clearly, those markets more locally have been very impacted by risk aversion, and that's opened up quite a few opportunities, particularly in the value space within those markets.
I imagine you're referring to Italy and Spain over, say, Greece.
Yeah, Greece is, I would say, you know, reasonably high risk still, but I think that you have some very global international businesses operating from Spain and Italy, and those are the businesses that we're finding, you know, companies that have quite low exposure to the domestic markets but very high exposure to international growth. Okay,
how would you explain then this apparent disconnect between the state of the European and Eurozone economy and the markets themselves, which seem to be doing pretty well?
Well, I think that's justified. I mean, what we have, as I say, we have markets trading on the European market on a forward earnings basis is on about 11 times. And if you look at the earnings number within that multiple, we are trading at sort of about 40% below 2007 peak from an earnings perspective, whereas perhaps, for example, in the US, we're somewhere near a 10% premium to that level of earnings. So from a valuation perspective, we're not trading at very high multiples, and that earnings figure that I've quoted is actually trading at relatively depressed levels. So as soon as we do get some pickup in the underlying economies in Europe, I think there could be earnings growth as well as the prospect of a re-rating of the overall market.